but I do want to cover just real quick on what we provide to you through Crump. So if you're not familiar with who we are a product provider, but we are not an insurance company, and that's the big differentiation. We are not a carrier. What that does for you, though, is it provides you all the carrier specifics, all the carrier product, all the carrier information through an unbiased filter. We don't care which product it is. We don't care which company it is. You know, if you call a specific company, what do they want you to sell? Their product. And sometimes they may give you information that makes their product look a little nicer than it actually might be. We don't, you know, we're indifferent. You have access to 30 different insurance companies and hundreds of different insurance solutions by utilizing Crump, and that's really the key. And there's contact sheets here. That's really how I want you to understand us is I've got a solution. I've got an insurance case. I need a solution. Pick up the phone, call us, and we have multiple different people to call. But understand that it's not only for just life, just annuities, it's also the long-term care and the DI. And it's really an underserved market, the LTC and the DI. I'm not going to talk about them tonight. We can schedule another time because I really want to focus on the annuity market space. So we talk about the annuity markets, and everybody's got a different opinion what the word annuity is, right? You hear, oh, annuities are bad, or annuities are expensive. You know, we're going to focus specifically on the index annuity market because that's where our world is. That is primarily where your world is. Okay, understand that that market is an enormous opportunity. So 2016, so pre-DOL. Everybody understand what DOL is, right? That fiduciary standard. Understand that it's coming back. It's gone right now, or at least it's delayed for right now. At some point in the future, it will come back. It probably won't be DOL as the initials. It'll be SEC, or it'll be NAIC. What that means to you is right now there's no restrictions, so if you have opportunities, you should definitely jump on them. At some point in the future, it may require another license. I don't know. Nobody seems to know, but having a 6, a 65, and a 63 automatically gets you in the game, right? That's great. Understand that 2016 was an unrestricted market, and the market did about $65 billion in index annuities. $65 billion in new money index annuities. 2017, DOL wreaked havoc on the market for about half the year. It was a down year. It was actually a good year, but it was down because of total sales. DOL was about $60 billion. 2 years, that's $125 billion going into one product set, and that is just the fixed indexed annuities. The annuity market in total did about $400 million in that time period.
Billion.
I'm sorry, 400 billion, correct, thank you. 400 billion and 125 went into just these products. These numbers continue to grow while the other, the shares of the other products continue to shrink. The VA market is starting to shrink a little bit, starting to pull back from that market. So the opportunity is enormous here. You know, when you think about the market, this is the bulk of the index annuity market. These are the products that are approved for you, and they represent about 85% of the premium that was written in the United States last year. So are there products you don't have access to? Yes, but you have access to the number 1, the number 2, the number 3, the number 4 written products in the US. The bulk of the business is going to the top companies, right? You have access to all of those companies. I'm going to focus on a couple of them. Today I'm going to talk about some specifics, but when you think about niches, right, everybody's got niches. Every product, every company's got some niches. There's some really good ones up here. Allianz is the number 1 company in they have been for the last like 7 years in a row. I think they were 1 quarter they were not number 1. They write some very innovative products. They are always based on income. You know, some of the companies like Athene copied a lot of what Allianz is doing. They're the number 2 product in the industry right now. Nationwide, number 3. Understand that WFG is one of the big reasons that product even exists, and you have exclusive distribution. There's only a couple of groups in the US that even sell that product. That's the number 3 product in the US. It will probably be number 2 this year. So you guys are making a huge impact on that. But Delaware Life, Lincoln, American National, Transamerica, all these companies have very specific products that all do something a little different. If you're talking to me about early income, Transamerica, number 1 in the industry. You want to take income today? They're going to be the number 1. If you're looking for bonuses and stuff like that, North American. If you're looking for increases in your payout structure, Lincoln. You got American National does some really cool stuff, especially in New York. If you have clients in New York, it's one of the only products available. Everybody's got a cool niche. This opportunity is way bigger than the 125 billion that went in. Okay, understand that that's just went into these products. Everybody's very familiar with this side of the market, the stocks, the mutual funds, the bonds. Everybody understands. Market goes up, but also market goes down. I could be at risk. Some people like that, some people don't. The people who don't, unfortunately, only know about this side of the market. Where do they go? They go to the banks. They go to their local banker. They go to Susie behind the desk, who says, look at our cool CD rates, 0.7%. $14 trillion sits over there. 14 trillion. That's unreal. $14 trillion is earning less than 1%. And most of the time it's taxable because it's non-qualified. So every interest, anything they get credit interest that year, they're paying tax on. Think about that opportunity. If you could talk to your clients about a product that had zero risk, but potentially 3, 4, 5% returns on an annual basis, you think they'd say, yeah, tell me more? Absolutely. The reason that the money sits over here is because the banks will never tell the clients that there's an alternative. Banks make money one way, on deposits, and then they loan those monies out. Right? That's it. They don't want a customer knowing about a product that's not a bank product. Right. So they are not going to tell them. I can guarantee you, if a client goes and you tell that client to go to the bank and tell them, you know what, somebody else has told me about this fixed index annuity, they're going to say, oh, you know what, we sell those too. Only to keep the money in-house. But they will never lead with that product. So ask your clients. If you have clients over the age of 50, they probably have bank products. They probably have CDs. They probably have more than they need to in their savings accounts. It's amazing how much money sits in savings accounts. Hundreds of thousands of dollars because customers don't know what else to do with it.
Right.
And they certainly don't want this because they don't want to risk it. Opportunity, makes sense?
Yep.
Good. All right, so let's talk about a little bit of product and how to position these products. You guys are probably pretty familiar with the brand. You ever see that name before? Yeah, I think so. The nice thing is everybody in America has seen that brand. They have one of the best positive brand recognitions in the country. You cannot drive the car and hear that commercial and not go, I mean, you can't not do it. The kids are doing it in the back seat. You got Peyton Manning, you got Brad Paisley, you got all these positive brands. They have a great product to go along with it. So if you're not familiar with the New Heights product, it is an index annuity like everybody else's. It has a lot of similarities to the other products, but what it does differently, and it's really unique, is they look at the values daily. So like all the other ones, it's a principally protected product. What does that mean? It means my customers cannot lose money. They put $100,000 in this product. No matter what happens in the market, it's always worth at least $100,000. That's what customers are looking for. It's an index annuity, so it has opportunity for growth based on an index, pretty similar to all the other indexes out there. And like all the other ones out there, or the majority of them, they have multiple options for indexing. You can choose different buckets to index. And that's really where the similarities stop. What makes the Nationwide product so unique is the only product in the industry, and it is patented, that can track values daily. Every other index product out there, and they're all really good products. You buy the contract, and on day 364 of the contract, your value is the same as it was when you bought it. On day 365, they're going to calculate what your interest rate was. Day 364, nothing's changed. Market turns on day 364 and goes back down to where it started, you get a 0 for the year. This contract actually looks at the values every single day the market's open, and the market's open about, what, 250 days a year. Take out the weekends, take out the holidays. I think it's like 257, something like that. But let's call it 250 to make the math easy. It has the ability to track it daily. It also has the ability to credit those gains to date for withdrawals, for death purposes, and for income purposes. Also allows the client to lock in any of those gains during the contract period, and I'll show you how that works here in a second. And again, it's the only product in the industry that does that because it is patented. And it's an up-and-coming seller, no question about it. Like all the other products, it has multiple indices. The S&P 500, everybody knows. It's a US-based stock index. You've got the EFA, which is European, Canada, US. It's an international stock market. And then you've got the other two, which are dynamic indexes, or what most people call volatility control indexes. Okay? Basically, it's a diversified managed index. So let's look at this one first. The JP Morgan Mosaic 2, by far the most popular. It's their #1 seller. What it is it's 4 different countries. It's the United States, it's the UK, Germany, and Japan, and it's 15 different asset classes. So you've got equities, you've got fixed income, and you've got commodities. What it does is it looks at it every 30 days, and it rebalances from 15 different indexes to the top 9 performing from the last 6 months. So every 30 days, it's rebalancing based upon the last 6 months. So it's whatever the last 6 months momentum's done, it's rebalancing. It's basically a diversified portfolio. If you had a client who had $1 million and they wanted you to diversify a portfolio for them, you're going to go out and you're going to buy equities, and you're going to buy maybe some commodities, and you're going to buy fixed income, and you're going to buy it in different sectors probably. Normally, a diversified portfolio like that would have a threshold of maybe $500,000, maybe $1 million. You don't just get to get people's money managers involved for 25 grand. Here's an opportunity for clients to buy that diversified portfolio with a minimum premium of 25,000. It gives them the same kind of returns as an index, as a balanced allocation would, with none of the risk. Because no matter what, if this thing goes to zero, your client doesn't lose a penny. It's pretty cool. The New York Stock Exchange Zebra Edge is a U.S. large cap stock. And as you would guess, last year, this index did fantastic. It was a 17%er. Awesome returns. It's U.S. large cap only. What it does is it looks at the 500 largest stocks and pulls out the hot stocks. What's a hot stock? Follow stocks. The Amazons, the Googles, the ones that are moving up and down, the ones that everybody's talking about all the time. What it's looking at is it's keeping basically the value stocks, the blue chips, the ones who are less volatile. And last year, like I said, it did over a 17% return. This one did over 6. Well, which one's better? Well, clearly this is a better performer last year. What's it going to do next year? Probably not 17%. I hope it does, but probably not. This is one of those indexes that kind of does this. It's really consistent. It just continues to grow. This one does this. Which one's better?
Consistency.
Well, consistent is more consistent, no question. You know, we don't know what it's going to do, but I like a consistent growth every year, and I think most people would agree. But 17% last year is a pretty darn.
Eric, that's 100% equities?
It's a U.S. stock, large cap.
Wow.
Yep, and it's managed by Roger Ibbotson. If you're familiar
Sure.
with who Roger Ibbotson is, it's New York. It's the only index that's managed by the New York Stock Exchange. It was designed by Roger Ibbotson. He did a great white paper on it. We've got a whole presentation that Roger Ibbotson actually gave on it too, if you're ever interested. But it is, you're right, it's U.S. large cap. That's what it is. So
with Nationwide, though, you can't pick more than one at any.
you can, but you have to split up the contracts.
You have to split up the contracts.
Yeah, correct.
Okay.
And you can reallocate, but you can't split them up inside. Yeah.
Okay.
You know, the key is, and understand that this is a relatively new index. It's only a little over a year old. So all we have is a year's worth of history.
A pretty good year.
Yeah, it was a good way to start the index, yeah. And when this came out, nobody bought it because, like, well, why would I buy that? You know, Mosaic is way cooler, so it's what it is. So people are learning they're going to buy it this year, and it's not going to perform as well. That's how we're, I buy high, sell low. Isn't that how you guys do it too? So that's the way I do it. So understand that and these rates are effective tomorrow. That they have the same par rates now. So the J.P. Morgan and the Zebra are the same par rates now, effective tomorrow. Today they're a little bit less on the Zebra, but this is the 9-year contract. It has an 8, a 9, and a 10-year option. Everybody buys the 9-year. The 9-year has the highest participation rates. It has the highest income, illustrated income. It has the highest commission. That's why everybody buys the 9-year. So the 10-year and the 8-year are a 2-year reset. The 9-year is a 3-year, and I'll show you what the difference is here in a second, okay? But understand that 150% participation rate is applied every single day. So you buy the contract today, tomorrow they're going to apply 150% participation in any positive change. Then they're going to minus out 1% spread coming off the growth. So every single day, the customer can log in and see where their contract sits. That balanced allocation value, that's what they call it, the BAV, is going to change every single day. It's going to go up and it can go down, but no, it will never go below whatever your locked-in value was. You put in 100 grand, market goes down 40%, you still got 100 grand, okay? But that value is going to change, and that calculation happens every single day. If you don't like the 1% spread, you can buy the option 2, 120% par, no spread. Which one's better? Tell me what the market's going to do. If the market's going to return on average better than 4%, then option A is going to be better. If it's going to return 3, hopefully it doesn't return 3. Hopefully it's much, much better than that. But kind of the area. The Zebra is the same thing. That the par rates are the same. If you look at S&P and EFA, they're available, I would recommend another product. Just honestly, I think another product would be better if the S&P is where you want to allocate your money to. But it's still available, okay? We're going to focus on the JP Morgan Mosaic because that is by leaps and bounds their #1 sold and has been the best performer over long haul. So this is what the illustration looks like. You buy the contract, you put your $100,000 in. Your contract value, your cash value, only changes every 3 years. So every third year, it's going to lock in whatever that value is. And that value is the BAV. That's the number that's going to change every single day. So whatever the difference is between where you start and where it is that day, times 150% participation minus a 1% spread annually. Remember, it's annually. Okay? So if the market's up 10% when you check it, times 150%, that's a 15% return minus 1%. That's why this number looks why that number is, okay? It does that every single day. The client can log in on their phone every single day. What's cool about that is they see the actual performance as it goes through the year. Remember, day 364 of anybody else's contract, the value is exactly the same as it was the first day. Nothing exciting about that. The customer's going to get a quarterly statement. They're going to get 4 statements a year. Again, they can check the value every single day as well. It looks a lot like a variable annuity with 0 risk. The market goes down 150%, or not 150%, 50%, drops massively. The customer has not lost a penny. This value would just go back to whatever its lowest point was, which is 100. On the 3rd anniversary, it's automatically going to lock that number in if you don't do anything. I'll talk about that here in a second. And that's your new low spot. It can never go backwards from the 119. And it's going to continue that every 3 years. The client, during the 3-year time period, or the 2 for the 8 and the 10-year product, has the ability to lock this number in manually. It does it automatically on the 3rd anniversary or the 2nd anniversary, but the client can lock it in manually if they want to. Why would a client want to do that, right? If the market is up and they know it's going to fall, how would somebody know it's going to fall? Well, be significant events, right? It could be a war event. It could be the housing crisis, total meltdown of the financial markets. There are a lot of things. My brain would tell me it would have to be something pretty significant, because remember, once you lock it in, you don't get to go up either.
Until the next contract.
Until the next third anniversary. So you lock it in 6 months in,
that's it.
You're out of the market for 2.5 more years. I mean, you're not in the market, but your index is frozen for 2.5 years. You know, if you're 2.5 years in and you see some significant activity that you think is going to make the market decline, might not be a bad idea. At least lock it in. If the market comes back up, you don't get to participate, but it's only for a 6-month period.
And the spread, they don't charge the spread over the next 2 years?
No, the spread is the same, 1 per year.
Each year, no matter what?
No matter what.
So you just have to be willing to give that up.
It's just coming off the top. It's coming off the growth only. Never goes against your cash value.
Yeah.
So upside potential could be fantastic, right? You've got an average return, and again, this is average, of over 6% average return per year. Is that what it's going to do in the future? Have no idea. But remember, you're in a product that has 0 risk, that you're comparing it to other 0 risk products. It's not a variable product. You don't want to compare it to a variable product. What it's like is a fixed product. Fixed is bank, under 1% normally, okay? This product, incredibly aggressive from a growth perspective. It also has income features. Understand that this product, from an income rider perspective, is probably going to be one of the highest incomes your client will receive with market performance. It is a market-based product, or I'm sorry, performance-based product. If your client's looking for guarantees, it's not really the strongest product. Its guarantee is a 1% roll-up for 10 years. It's compounded, at least it's not simple, but 1% compounded is not overly exciting. But the customer gets the higher of 1% or whatever that higher value is, and I'll show you how that's calculated in a second, times, like everybody else's, times a payout factor. That payout factor is one of the highest in the industry, and most likely will be the highest in the industry because of their calculation method. So let's take a 60-year-old client, and we're going to wait 10 years for income. Okay, go out to here. At age 70, their payout factor will be 7.37%. It doesn't sound all that exciting, except that the entire industry will be at 5 to 5.5% for that age. 7.37 is significantly better, 50% better almost. If you wait 5 additional years, so you go from 60 to 75, your payout is 10.85%. Again, the industry would be at 5.5 to 6, almost double the payout factor. So the question now is 10.85 or 7.37 of what? Because it's just a mathematical calculation. What does that mean? What's great is when you buy the income rider, now we talked about the lock-in feature, when you buy the income rider, it automatically locks it in for you. It does it automatically every single day. If the market goes up today, they lock it in. If the market goes down, you stay at that lock-in. It does that automatically. You don't have to do a single thing for income purposes. That BAV, the high point income rider, goes up every time the market goes up. Locks it in every single time. So in this example, 60, I'm waiting until 70 to turn on income, so 10 years, 2,500 data points. Again, rough math, right? The highest point on that chart, 2,500 days, times 7.37 in this scenario. Your income is a little over $13,000. With reasonable market growth, $13,000 is a good 20% higher than everybody else's in the industry. Is that what it's going to do? No idea. What happens if the market doesn't grow at all? Still got a guarantee. The guarantee is about $8,100. This example, the guarantee is $8,140. It's not horrible. It's actually in line with some other companies' guarantees. But remember what that has to assume. That has to assume you buy it today and the market never goes positive for 10 straight years.
Yeah.
10 years in a row, the market goes down and stays down. Is that going to happen? Oh God, I hope not. Could it? Well, sure, it could. But I think we're thinking about a very, very extreme market condition. Again, it could be a war. I mean, you know, you could think of a whole different reason, a bunch of different reasons. Most likely, you're going to be somewhere in between, right? The 8,000 and 13,000. 9,000, 12,000, could be 15,000. Who knows? Understand that the one thing you have to remember on this product is you have to wait 5 years to turn on the income. You'll notice it doesn't let you turn it on for the first 5 years. Not a good early income product, obviously. But the longer you wait, because there's no maximum, and I don't want to say roll up because it doesn't have a roll up, but there is no maximum of the next high point. It doesn't turn off at 10 years or 15 years or 20 years. Every single time while in deferral, it has a new high point, it locks that new high point in. It even works after you turn on the income. If for some reason this value surpasses your income point, it will bump it up and your income can increase. You'll see it here, but that's because we had really high returns in that year. It moved slightly. I would not expect that. It's possible. It's possible with everybody's product. So, understand. Make sense?
Yep.
Yep.
I mean, I like this product for customers who believe in the stock market. They like the market, they're just too close to retirement, or they've lost money in the past and they just can't handle loss. They know that it's the place to be. They know that the bank is not paying them what they should be getting, but they just can't handle the risk because this product offers them that upside with none of the downside. And the income potential could be significantly higher than everybody else's. And the name doesn't hurt.
Yeah.
The brand is sometimes a lot more than just how the product works. Make sense?
Yep. Yep.
Okay, good. So I want to compare it to a product, the Athene Ascent Pro. This is a very popular product. This is the #2 sold product in the country. And there's a reason, because it is incredible.